Is it morning? Is it afternoon? Good morning, and thank you for having me. My name is Martin Maringi. I have been given a very tough job of summarizing the evolution of the 60 years of the Bermuda insurance industry in 15 minutes. So please bear with me. To start us off, Jeff gave us a very good introduction to the session. And he spoke about the importance of the industry that we are in and the role that the industry plays in terms of covering risks and helping people whenever they are faced with challenges. Just to get us starting, I'll start there. I'll start with the issue of protection gap. And here are some statistics that most of you are aware of, most of you have seen, most of you have experienced, that there's a huge protection gap in the insurance industry. And that gap is growing. That's not just in specific jurisdictions, but it's across jurisdictions, across the entire world, across different perils. If you look at things like pensions, you look at things like climate risk, you look at things like cyber, astronomical figures as far as protection gaps are concerned. So one of the main problems, and what our industry is trying to do and solve for, is the big challenge of protection gap. And that's part of the reason why the industry exists, and that's what it's really trying to address and resolve. But there's another problem, and this problem is the issue of capital. And when you look at the state of the capital in the market, what we have seen is capital is leaving the market. Capital is not coming in. And by that, I mean the capital that's in the publicly listed segments of the market. It's not coming in, it's leaving. One minute, I'm trying to get my slides. Apologies. But in summary, I'll keep going. They'll give me a signal. There were some pretty slides that we had prepared. They'll show up in a minute. But in summary, we are faced with a market where there's a growing protection need. There's a growing protection gap. On the other hand, we have a different problem, and that is, instead of capital flowing into this section of the market, to our insurance industry, capital is actually leaving. McKinsey has published a report, and basically that report shows that over the last decade, $275 billion of capital has left the reinsurance market, and that is the publicly listed life and annuity writers in North America, and has been returned to the shareholders. Out of that portion, 70% of it, which is about 200 billion of that, has gone back in the form of, share buybacks. Back to my slides. So just to give us an idea of the issues here, we have a slide here from GFIA, and it basically just quantifies the size of the protection gap. But basically, in a nutshell, it's huge. We are talking of astronomical sort of figures, trillions and trillions of dollars of gaps per annum, and over the years, tens of trillions of dollars. That's a message we get. As you look at this picture, we ask ourselves, what role has Bermuda reinsurance market played in addressing this gap? To help us deconstruct this, we share with you a picture or an image that shows the significant role played by the Bermuda reinsurance market. In this slide, it's basically a view of the claims paid by our reinsurance market. Over the last 8 years, just 8 years, the Bermuda reinsurance market has paid almost $1 trillion in claims. One other piece that you may pick from this has been paid across the entire world, with the US being the leader in this. Europe is another significant market, but other beneficiaries of the claims paid by the reinsurance in this market is also across the world. And you can see that the rest of the world is also growing. It's a number that's increasing over time. And you may ask yourself, why has the Bermuda market been able to play this significant role? There are many reasons. I'll provide two very briefly. One is to do with the market's ability to attract capital and to have formation of capital taking place in the Bermuda reinsurance market. That's a critical part of it. The other piece is to do with the talent that's here that's able to take all the risks from the global markets and diversify those risks and form them into concrete balance sheets that can be underwritten, that can be understood by the investors. So in a nutshell, we take capital from all sources, from different types of investors, from different jurisdictions, from across the world, and we also take risk from different types of zones, geographical zones, and diversify that and underwrite them here in Bermuda. Those are the main explanations behind why we have been able to play such a significant role in narrowing the global protection gap. Moving on to the evolution of the Bermuda reinsurance market. We will share with you insights from 3 reports that we have published as the BMA. The first report is a report about the collateral structures in the Bermuda market. One may ask, why did the BMA choose to publish a report on collateral structures? What was exactly the end we had in mind? To put that into some context, what we have found is that there had been a perception, and what we think is actually an incorrect perception, an incorrect understanding of the market in this form. When we spoke with stakeholders, and we engaged with a lot of stakeholders at an international level across the whole world, they had the perception that the trillion of assets that you had referenced in the previous panel are assets that the ceding entities in different jurisdictions have taken, and they have taken those assets and transferred those assets to the Bermuda reinsurance market, and the Bermuda reinsurance market have full discretion over the manner in which they invest those assets. That's wrong. That's an incorrect assumption. In reality, what we find, as you can see from the slide here, 80% of those assets are pledged as collateral to the ceding reinsurers. And what are the structures we find in those markets, and what are the implications of those collateral structures? A majority of that, which is the big section in blue, are funds withheld and MODCO accounts. What does that mean? Up to 70% of the assets. What does that mean? Why does it matter that they are in a funds withheld or MODCO? It matters a lot. It means that the ceding insurer has to continue to carry these assets on its balance sheet, report to its board, report to its regulator, and report them on its own balance sheet. So in terms of the governance relating to those assets, post the reinsurer, the ceding insurance entity has to continue to have that visibility into the assets themselves and continue to exercise appropriate governance. That's as far as funds withheld MODCOs are concerned. But what are the other benefits of this structure? It starts from the day one of the transactions. When the transactions are put together, the ceding insurer, meaning the ceding entity, has to agree the investment guidelines that are going to govern those assets over the life of that transaction. That means they look at concentration limits in terms of the types of assets they want, asset allocation limits, counterparty limits, currency limits. Everything to do with those assets has to be agreed with the ceding insurer. And what about over the life of that transactions? Are the assets opaque? Are they hidden? Does the insurer company have the ability to view the assets that are backing their contract? The answer is yes. In fact, when you look at the reinsurance agreement, the ceding entities have a lot of rights in terms of they can value the assets at any time, they can monitor the assets at any time, they can monitor the assets during periods of crisis. And in addition to all this, they can demand for collateral top-ups, meaning in the event the asset that they are concerned about, they can demand that the insurer tops up the collateral. And more important, those collateral top-ups and those assets that are needed to top up collateral, that's what we supervise. This is part of our job to make sure that the companies have the ability to meet those collateral requirements, and that's part of what the capital comes into play for. Another question we asked ourselves, we all agree that a significant majority of the assets are actually not given to the Bermuda insurance companies, and the reinsurance companies don't have discretion over the assets. But what can we say about both the quality of the assets held by Bermuda reinsurers, as well as how do they compare across different jurisdictions? The slide I'm showing here is a slide, it's not our data, it's actually a slide by Moody's. So Moody's published a report. And what this report shows is, number one, an important difference in asset allocation across jurisdictions. On the top side, you have the US and Bermuda. The asset allocation between Bermuda and the US are pretty much similar. But there's also a significant difference between the asset allocations between US and Bermuda versus Europe and Japan. What you find when it comes to Europe and Japan, there's significantly more allocation to equities compared to the amount of equities carried by the US and Bermuda insurers. The other point to pick from this, yes, indeed, both the US and Bermuda have significantly more allocation to structured assets. This is what Moody's calls here private credit assets. But as I leave this slide, and the message I wanted to leave you with is that looking at data, we don't find any differences between the assets held by Bermuda insurers and those held by our major market. That's the US, broadly speaking. Drilling into this and looking more at the quality of the assets. So we now know we have a lot of similarities between Bermuda as well as US. But what about the credit quality of the assets? What do they look like? In a nutshell, we have published a report that covers the asset allocation, that covers the quality of the assets. But a majority of the assets, yes, indeed, the industry does have exposure to private assets. But one of the guardrails employed by the industry is the quality of those assets. This is not data that had been published in the past. We now have it in our website, and you can go look at the report. The report basically shows up to 80% of the assets are investment grade. A portion of it is unrated, yes, indeed, and most of that is in mortgages. This is not unusual. It's exactly what we see in other markets and in different markets. We went further, and we said, what about the liquidity of the assets held by the Bermuda insurers? To help us understand this from a data point of view, not just high-level statement, but purely from a data point of view, we performed stress tests. There were 3 types of stress tests. One of the stress tests is a mild stress test. That's the one in blue. The next one is a more severe stress test. It's a 1 in 200 shock. And the last one is using not a BMA criteria, but an IIAS criteria. We shocked the insurance companies to these events, and we looked at what's their liquidity coverage ratios. In a nutshell, the liquidity coverage ratios ranged from 360 to 560. That's at least 3 to 5 times the liquidity coverage ratios that are needed. What does all this tell us about the market at large? The main takeaway that we take from the market is that when you look at the data on aggregate, we do not have fundamental concerns with how the market is operating. Yes, indeed, that's the information we have shared is all about the average insurance company. Of course, there are companies that are outliers. There are companies that we are concerned about their liquidity levels. But these are normal, routine, supervisory issues that we continue to engage with these companies and have discussions with them to understand how they are addressing these issues and the steps that they need to take. That's a majority of where we are spending most of our time. The information we have shared is also available on our website. We welcome you to take a look at the slides. I've provided a link to the slides. That's a link to the slides. The slides will be shared, and you can get access to these specific reports. If anyone has any questions concerning the reports, please reach out to us. We'll be more than happy to engage in a conversation. In closing, we want to leave you with perhaps 2 or 3 messages. The first one is being that the Bermuda reinsurance market plays a vital role in closing protection gap. There's a lot of statistics to show that. The main evidence of that is the $1 trillion of claims that have been paid by Bermuda reinsurance markets. That's one. The main reason why the Bermuda reinsurance market has been successful in doing so and in narrowing that protection gap is in part because of the proven track record of the market's ability to attract capital into the sector. This is crucially important, especially in a time when capital has been leaving the market, not coming in, but leaving the market. The third thing, we are paying attention. We are ultimately a regulator. As you have heard, we have made a lot of enhancements to our regulatory toolkit. We have, for example, required approval of block transactions. Those now need to come to us. And by the way, as part of that approval process, we discuss those transactions with the cedants regulators. Another area of enhancements we have made is to do with the capital requirements and the reserve valuation standards. Connected with all this, we have enhanced our reporting requirements. We are now requiring, for example, disclosures on the private assets about the assets that have been, for example, paid in kind but not paid in cash. Those disclosures will be coming to us. In closing, and appreciating the important role that this sector plays, we are watching. We appreciate the time you have given us to speak about this evolution in the insurance market. We look forward to working with all of you as we implement effective, high-quality supervision of the insurance sector. Thank you very much. Thank you.